Hello traders, welcome to FreeFX. Today we're going to talk about the SPX. One of you requested in a poll that I conducted on FreeFX recently that I cover some fundamentals as well. So I decided to obviously do that today, and this might be a good time for me to also learn something new, because obviously that is how I learn, is kind of doing videos and also kind of getting some information about particular topics that might be of interest to yourselves. So first thing I'm going to do is show you my SPX chart, which is looking quite cluttered. I realized that there's quite a lot on it already, but the reason why I've got so many things is that essentially what I'm showing here is let's start with exactly that, which is what is the chart showing. We have the usual stuff you've seen before, the parallel channel there for the SPX, but also I've got some extra stuff here. So if I just sort of take them down one at a time. So the first thing you'll see is a parallel channel running across and in the opposite direction. Which is no coincidence, because what you're seeing in there is the 10-year US treasury 10-year yield. In fact, so price would be inverted to yield, so we're showing just the yield, and that is this dark green line. Okay, now it only goes back on this particular feed to August 21, so we don't have the full picture, but it's enough, I suppose, for what we need to see now, which is where the situation that we're in, where yields are rising and the 10 years rising, and obviously the 2 years rising even faster, which gives you that inversion that we've seen. So the 10-year 2-year spread inversion is what we see in a lot of reports, and that's been in the deepest decline, and so that's a sign of a recession coming, and it's been referred to a lot as the 10-2 or 10-year 2-year yield spread. We only got the 10-year here, and why is the 10-year important? Well, obviously, so treasury is a risk-free investment, so you are essentially holding to maturity, if you like, and essentially the face value is what you get. So if you get treasury that pays X on expiration, you pay what you get for. Essentially, it's a risk-free way to keep your money safe. It's US government backed. It is a very secure hedge in times of uncertainty, or surely any time really. But the important thing about this is that you can also speculatively obviously sell it off when the price rises before it expires and reaches maturity. And that means that you can make a profit if it rises, or if it falls, you don't obviously sell it for a worse price, and you just wait for it to expire, and that's kind of a way to profit from it. Obviously, the percentage as it's measured here is tied to interest rates as well. So as you can see, a rising rate quickly through 2022 has pushed up yield for the 10-year treasury to these levels. The peak there was in the middle of October, and then that was around 4.1%. What's interesting is I put this parallel channel there because if you kind of continue this kind of wavering line, you might get to something like 5% by first quarter 23, or maybe that's too ambitious. You might go for 4.6% first quarter 23, etc. And then it's interesting to look at predictions. So for example, if you look at the trading economics, we've got for the US first quarter 23 is 4.1, second quarter is 4.28, so second quarter would be April. 4.2, I measured it earlier, actually sits along this channel, as you can see, April, and it's just sitting on this at the bottom of the channel there. So, but then it says that by quarter 3 it's 4.4, 4.4 third quarter, so June onwards would be here, and that would be 4.4, so actually lower than that parallel channel, about here, so it's just kind of below that. So either we create a second channel with a kind of filter zone around, just like we've done here for the SPX, or maybe that's the point where yields start dropping. Why then? Well, because we expect the Federal Reserve to start kind of leveling out by the middle of next year, roughly. So that's kind of where maybe the yields will start kind of dropping from 10-year. So do yields for the 10-year and the SPX or the US indices always have this kind of inverse correlation? Well, not always. As you can see, for example, from February 22, there was a big rise there until March. So about a month we had rising stocks and rising yields. But then we had this big drop in April, etc. So that's where the deep decline started kind of really taking hold. And then we had the yield obviously in the opposite direction, and we sort of had a second one drop here from the so-called bear market rally of July, August down to end of September. That was again another push higher. So another one we can compare to is the dollar. That gets really complicated now, but let's kind of have a look at, because the dollar obviously benefits from higher interest rates. So if we had the DXY and put it to a new price scale, this gets a bit messy, but we'll try to I'll do my best to illustrate this with all this information on, which could be hidden, I suppose, but I think it's probably as we want to really see everything. Probably just as well. I'm going to use red, just make it a little bit more visible there. Okay, so that's the US dollar DXY, which is obviously currency weighted index. Is a kind of synthetic index. I think it's 60% weighted to the euro. So Euro USD has a massive kind of impact on what we see here as a derived price. As you can see, the US dollar is heavily correlated for some time, or has been this year, to the 10-year yields. Drops come in similar places, and peaks have come in similar places, and obviously we had this I suppose softening there just at the end. Now the scale might be slightly off, so I mean we could make it maybe a tad more compatible by just maybe flattening that, and you can see already that the 10-year yield and the dollar look very similar. So if you just kind of scale it slightly flatter, then you can see that comparison really holding. There used to be something called it was a Currensee heat map. Currensee, I think, was bought over by Oanda, if I remember correctly. Currensee was yeah, I think it was bought by Oanda. So currency correlation heat map, but I don't think it's there anymore. It's been a while since. Try and see if it's still there. No, I think that's just, oh yes it is. Ah, fantastic. So Oanda bought it, I think, and this is really handy. So let's have a look at the bubble heat map or bubble. I think I quite like the bubble, so that's what I used to use. Now this is everything kind of mixed up. So if I look at Euro USD versus the US dollar, I think there should be the US dollar under DX. Let's see if we've got just the US dollar. US dollar by itself rather than as a currency pair. US dollar by itself is not under the currencies, so I'm wondering if it's maybe if I do a quick search. But just to show you this heat map, which is really handy. It's not actually under, maybe just USD. We'll give them lots of them. We'll try and do DXY. Okay, it's not showing us that. But what's really important here, if I do SPX, there it is, USP5. Yeah, okay. So versus USD. Sorry, I can't speak. Euro USD versus S&P 500 in the form of the SPX. According to this heat map, and this is 1 hour to 1 year correlation, obviously the negative correlation is in blue, and the positive is in red. So the bigger the bubble, the higher the number. So this is almost 1 to 1, so highly positive, which means they kind of run in the same direction together. So euro to S&P 500 is very strongly correlated on a weekly basis at the moment, and also on a 3-month, 6-month, and 1 year. Actually, even more so in the short term than the FTSE 100. And then you can start looking at small cap, for example, Russell 2000. In the short term, not so much. If you look at the 10-year treasury, you can see again that correlation is there, but it's moderate, so it's not so persistent all the time, as I was kind of showing you earlier. So there are obviously correlations, and it tends to be negative, as I said. Anyway, so this is quite handy to see the correlation between asset classes and instruments, and I thought I'd kind of show you that quickly. But going back to the euro, I've kind of mentioned it before a few times how the euro is really sometimes surprisingly similar to, I'm going to save this, it's quite a handy one to have. It's a really good, that's my trade. I'm still short from that point there, which I've discussed before, and I'll hide this as well as the 10-year and take that off, and I think probably that might actually do for now. But I'm going to add the EUR/USD just to kind of show you one more thing, which is how we've got this correlation going on between the euro, as in EUR/USD, and the S&P 500. So if I just show you this, you will see what I mean. So there's I've done this before, right? So but I'm kind of showing you again. So there's the EUR/USD there. Obviously that's kind of to show you that the dollar obviously is benefiting from rate rises and not the S&P 500 or indices, and that's where that correlation with between the index here and the EUR/USD comes from, because the dollar index is heavily weighted with the a basket of currencies, and so the EUR/USD being the most the heaviest in that list to influence the price of the dollar index, it makes sense that it should move then together with the index, because obviously it's inverse to the dollar. So, and this is the situation. Now obviously before this, as you can see, it wasn't always thus. We had quite a number of things that you could say didn't quite match between the two, euro and the if I do this, okay, but now we do have this correlation, as you can see quite clearly. We've got the movements in the EUR/USD very closely correlated at times, not always obviously, but at times are closely correlated. So you can see these curves, and the general downtrend has maintained its parallel to the S&P 500 at times. Again, this big rise here didn't really match one here in July. So the so-called bear market rally of July, August didn't really materialize for the euro. So again, considerations there for you to reflect on, but there are some occasionally some kind of risk on elements to EUR/USD, like here for example, in 2020, after sort of post-pandemic recovery, there was EUR/USD sort of rising there, and then that sort of actually curved and inverted. So the S&P continued rallying for another basically another 6 months more or less, whereas the EUR/USD started dropping. So that's basically where I'm at with the fundamentals today, and I just wanted to cover that aspect because it's kind of it's not just interesting to me, but it's kind of important to understand these things, looking for a way forward. And I have mentioned this also in my tweet, just slightly more technical note, which is that the CCI on the weekly chart, which is kind of all they've covered today, has been quite the winner in kind of determining what we have. And I think it's quite important to have this situation where we can look at a chart, one look at the chart, and just kind of determine very quickly how we have this kind of I'm just going to hide that. There we go. How we have this situation where a technical setup can really manifestly obediently almost follow the trend, or the trend rather following the technicals. And most of all, this arrow has been now in place for a couple of weeks, I think, probably longer. I think it's a couple of weeks now. Yeah, a couple of weeks. And it seems that it is kind of holding, so I'm just going to leave it there because it does kind of make some sense for now. And that's kind of where my target is, around this area. It may be ambitious because there's all that to cover, and it may not come in a straight line, but that CCI there is really peaking now. And as I mentioned before, we had these two peaks, one in March and one in August. So that's 5 months apart there, more or less, slightly less. And this is obviously a bit shorter between the two, but it is peaking nonetheless. And in fact, I should probably move that slightly to, that's kind of where the peak is, on the top of that range. And really, first red candle is here. So what I'm going to do is to reflect the same approach that should be there. And so the peak is now coinciding with the turn here, the red candle. So we've got this turning, presumably like before, in a sort of fairly steady movement down to below zero. So that's basically where we're heading now. How long that would be, as I said here, we had 7 straight weeks down in April and May. This was also 3 plus 3 with a green candle in between, so 6. Split between 3 and 3. Long kind of move up there, so again, being careful. Also long wick here in the middle of this move. That was the 5th candle, and this was 1, 2, 3, 4, 5. The 5th candle as well was kind of a bit of a dangerous one, if you like. So we've got 1, we're on to the 2nd, so the 3rd, the 4th, the 5th would be 12th of December week. And that would be potentially a little blip up. So, but we'll have to see what happens. So, ideally, we have a series of candles coming forward to take us all the way down to a new low. I kind of measured it before, but I'll do it again. If we took the top there down to the bottom of this, but really we should measure it to here. That's the 7 weeks. That's 14% down. So from where we are, kind of the top there, 14% down would take us 14.6, I think it was. So let's call it 14.7. Would take us exactly there. Would take us to that level. Yeah, we're pretty much spot on, kind of there. Couldn't really see it because it's right in front of it, so I'm going to do it this way round. There you go. Sorry about that. I'll try again. 14.6. It's about there. So that would take us to, what is that? 3407, which is exactly the same level indeed. Yeah, so which is the pre-pandemic high, as I mentioned before. I think it's like 3390. So we're roughly that area. So the 3400 is still very important, and that's what I'm going to finish with, which is that level is the target based on that move there, for example, based on the fact that there's the pre-pandemic high and all that. But obviously we were very close, very close indeed here back in early October, before this sort of move high, and that would have taken us right down to 3400, because we were just touching on the 350s, 3500, etc. So we're getting within reach of that but there's a wick down here, which is, yeah. And so that didn't happen then, but so we've got this. Now, obviously these two are fairly close visually, but they're still fairly further apart. So we'd have to see something going deeper than this low here, 3570, let's say. And we wanted to get it. That's why I'm pointing at that, because that's kind of the bottom of that channel. Of course, it could be slightly wider. You know, it could be this arrow could be sort of like this, or like this, or maybe not get to the bottom. It could be sort of here and then turn. But I'm just going to leave it there just to kind of visually illustrate what I'm trying to say here. I hope you enjoyed this video. I'm going to see you in my next video soon. Keep an eye out because I've got some interviews coming up as well. So always maybe subscribe, keep an eye on the channel and see what's going on with me, and the people that I'll be interviewing are absolutely top notch. So please stay tuned, and I'll see you in my next video. Have a good week, and if you're in the US, have a happy Thanksgiving. Take care, bye.